Welcome to the Maybe Not So Great Books channel. You decide. This is lesson 13 of 14, Dollar Cost Averaging and the Art of Doing Nothing from The Intelligent Investor, the definitive book on value investing by Benjamin Graham, commentary by Jason Zweig. The best investment strategy requires no skill, no timing, and no intelligence. Graham proved it. So why does nobody want to do it?
Well, that is really the ultimate paradox of the financial world, isn't it?
Yeah.
I mean, we've spent, 12 lessons now?
Hours upon hours.
Right, hours of discussion just talking about the sheer grinding effort of value investing. We've covered analyzing balance sheets, calculating the margin of safety, distinguishing between price and value.
Dissecting the earnings reports.
Exactly. Spotting accounting fraud. I mean, honestly, just listing it all out is exhausting.
It really is. Like, usually on this deep dive, we talk about digging into financial statements until your eyes basically bleed.
Yeah.
And we talk about having the courage of your convictions to stand alone when the entire market thinks you're completely crazy. Right. It's heroic stuff. It's very active. It's intense. But this lesson, lesson 13, it feels completely different.
It does.
It feels like the opposite of hard work. It almost feels like, cheating. Or maybe just being incredibly lazy.
Well, I can totally see why it feels that way.
Right.
But I'd argue it's actually the most sophisticated form of laziness you can find.
Okay.
It's strategic laziness. So today we are diving into section 9, specifically looking at chapter 5 and the concept of dollar cost averaging, or DCA.
Right.
And you're right to feel that tension there, because here we have Benjamin Graham, the dean of Wall Street.
It's the guy who literally invented the profession of security analysis.
Exactly. The man who taught Warren Buffett how to pick stocks.
Okay,
and he ultimately concludes that for the vast majority of people, specifically the defensive investor, the best method is mechanical.
Mechanical, meaning it requires absolutely no judgment at all.
Zero judgment.
So no judgment, no analysis, no timing. I mean, this is really for the listener who wants to build wealth, but quite frankly, has a life.
Yeah, exactly.
They don't want to spend their Sunday afternoons reading 10K filings. They don't want to agonize over whether the Federal Reserve is going to, cut rates next month.
No, they don't.
They want a system that works while they sleep.
Precisely. This is about removing the single biggest risk in investing. And as we've learned throughout this entire book, the biggest risk isn't the market crashing.
Right.
It isn't inflation. It isn't even the economy collapsing or some geopolitical crisis. The biggest risk is you.
The investor's own behavior.
It's your behavior. Lesson 13 is effectively about how to build a cage for your own psychology so you can't hurt yourself when the panic sets in.
Okay, let's unpack this, because on the surface, this makes absolutely no sense.
Sure.
Graham is the father of value investing.
He is.
And the whole point of value investing is that price matters.
Right.
You buy something when it's cheap, and you do not buy it when it's expensive. That is the golden rule. Buy low, sell high. That is the mantra.
In theory, yes. I mean, that is the objective of every investor who has ever lived.
So why is he recommending a strategy where you buy the exact same amount every single month, completely regardless of the price?
Well,
If the market is at an all-time high, you buy. If the market is crashing, you buy. Doesn't that violate the fundamental idea that price matters? It feels like you're just ignoring the price tag entirely.
it definitely seems like it does, but this is where it gets fascinating. This is really the hook of the entire lesson. Graham isn't saying price doesn't matter.
Okay.
He's saying that most investors are just fundamentally terrible at determining when the price is right.
Oh, interesting.
We think we know when stocks are expensive or cheap, but historically, retail investors are notoriously bad at timing these things. We get euphoric at the top and despondent at the bottom.
Right.
So instead of trying to be smart and failing, you adopt a system that mathematically forces you to exploit price fluctuations without even realizing you're doing it.
So it's the ignorance angle.
Yeah.
You're basically advocating for intentional ignorance.
It is radical acceptance of ignorance. It's admitting, I don't know what the market will do next week, and frankly, I don't care.
Wow.
And Graham backs this up with hard data. In chapter 5, he introduces us to a study by a researcher named Lucille Tomlinson.
Ah, yes. The Tomlinson Study.
Right. Now, this study was published around 1953 using data going back decades. It is, in my opinion, the absolute mic drop moment of the chapter.
I love a good study, especially one that has actually stood the test of time. So let's break it down for the listener. Who was Lucille Tomlinson, and what did she actually find?
So Lucille Tomlinson was a pioneering analyst in the mutual fund industry, arguably one of the first to really rigorously test formula plans. She was looking for a way to make investing safe for the common person. And she conducted this comprehensive test of the formula dollar cost averaging, investing a fixed sum of money into the Dow Jones Industrial Average at regular intervals.
Right.
And she didn't just look at one lucky period, where the market only went up. She looked at 23 separate 10-year purchase periods ending in 1952.
23 separate periods. Just to contextualize that for the listener, that covers the Roaring 20s, the Great Crash of 1929, the entire Great Depression, World War II, the post-war boom.
Yes.
I mean, that is a massive variety of economic climates. We're talking about times when the market dropped 89% and times when it doubled.
It literally covers everything. War, peace, boom, bust, hyperinflation, deflation. And here's the result, and I am quoting the source material directly here. No one has yet discovered any other formula for investing which can be used with so much confidence of ultimate success.
Confidence of ultimate success. That's incredibly strong language for a finance book.
It is.
Usually they're full of, legal disclaimers like past performance is not indicative of future results and your capital is at risk.
Yeah, the lawyers usually make them tone it down. But the statistic is what gives them that confidence. In Lucille Tomlinson's study, every single 10-year period produced a profit.
Every single one. Even the one starting in 1929.
Every single one, either at the very end of the 10 years or within 5 years of the end.
That's crazy.
Think about that scenario. You start buying at the absolute peak of the market in 1929. The Dow is about to lose 89% of its value.
Right. The world is practically falling apart.
Unemployment is hitting 25%. But if you just kept buying your fixed amount every single month through the Depression, you eventually made money.
That is wild.
Yeah.
Because if you had taken a lump sum, say, your entire life savings, and put it in at the peak of 1929, it took you 25 years just to break even on a nominal basis.
Exactly. And that's the contrast we really need to focus on. The enterprising investor, the one who tries to be smart, who tries to time the top or the bottom, often gets completely wiped out in scenarios like 1929.
Right, because they get emotional.
They buy at the top because everyone is making money. They panic at the bottom because the world is ending. They sell. They lock in the loss. But the investor who admits, I know nothing, and just buys mechanically, survives and thrives.
So the strategy works because you admit you don't know what you're doing.
Yeah.
It's humility weaponized.
It works because it neutralizes the emotional desire to stop.
Yeah.
When the market crashed in 1929 or 2000 or 2008, the smart money panicked.
Yeah.
The smart money sold to stop the bleeding. The dollar cost averaging system doesn't know panic. It doesn't read the newspaper. It doesn't watch CNBC. It just knows it's the first of the month, so it's time to buy.
It's almost robotic.
Very much so.
And by the end of this hour, we are going to explain exactly how this works, the math behind it, which is actually kind of magic, and why it is the only way for a normal person to survive against supercomputers and AI trading bots in 2026.
We're going to cover the mechanics, the psychology, and the limitations. Because there are limitations. This isn't a magical money printer. But first, we need to really understand the machine itself.
Right. Let's get into the core concept, section 2 of our outline, mechanics and psychology.
Okay.
For the listener who has heard the term dollar cost averaging thrown around on finance blogs, but maybe nodded along without knowing exactly how the math functions, let's break it down simply. What are we actually doing?
The definition is deceptively simple. You invest a fixed dollar amount at regular intervals, regardless of the level of the stock market.
So hypothetically, $500 a month, every month, forever.
Or $1,000 a quarter, or $50 a week. The specific amount matters a lot less than the consistency. The key variables are fixed dollar amount and regular intervals. You do not deviate. You treat it like a bill that must be paid, like your mortgage or your electricity.
Okay, simple enough. But how does that actually turn into profit? Why is that better than just buying a set number of shares? Like, why not just say, I'm going to buy 10 shares of an index fund every month? That feels like consistency too. Yeah. I'm building my position 10 shares at a time.
That is a critical distinction, and it's where most people get tripped up. It sounds similar, but the mathematical outcome is radically different. If you buy a fixed number of shares, say 10 shares, think about what happens to your wallet. When the price is high, let's say $100 a share, you have to spend $1,000 to get your 10 shares.
Okay, $1,000 out of pocket.
Now, let's say the market crashes. The price drops to $50. To buy your 10 shares, you only spend $500.
Right, so I'm spending more money when the stock is expensive and less money when it's cheap.
Exactly. You are putting more skin in the game when the game is expensive. That is the exact opposite of value investing. That is buying high. You are unconsciously weighing your portfolio toward expensive purchases.
I see. So fixing the share count forces you to be a bad investor. It forces you to overpay.
Correct. But with dollar cost averaging, you fix the dollars, not the shares. Let's look at the arithmetic described in Chapter 5. Let's run a quick simulation. You have $500 to invest this month.
Okay, I've got my $500 ready.
Scenario A. The market is hot. Prices are high. Let's say the share price of the fund you're buying is $100. How many shares do you get?
500 divided by 100, I get 5 shares.
Right, you get 5 shares. Now, scenario B. The market crashes. Panic in the streets. The share price drops to $50. It's a 50% haircut. You still put in your $500. How many shares do you get now?
500 divided by 50, I get 10 shares.
You are buying double the shares because they're half off.
It's automatic. I didn't have to decide to buy more. The math did it for me.
Correct. So, in the high market, you bought fewer shares, just 5. In the low market, you bought more shares, 10. The mathematical result is that over time, your average cost per share will always be lower than the average market price during that period.
Wait, hold on. Let me wrap my head around that. My average cost is lower than the average price. That sounds like a riddle. How can I pay less than the average price?
It's the difference between a weighted average and an arithmetic average. Because you bought more volume at the lower price has a heavier weight in your personal portfolio calculation.
And I think we need an analogy here. The source material mentions the grocery store logic, and I think that really helps visualize it.
It's the perfect analogy. Imagine you are buying steaks. You have a budget for your family barbecue.
I love steak. Let's do it.
So you go to the butcher, and steaks are $50 each, expensive, prime cuts, maybe only buy 2. You spend $100.
Okay, 2 expensive steaks, $100 gone.
Next week, you go back. There's a massive sale. The butcher is completely overstocked. The exact same steaks are $10 each.
I'm loading up the cart.
Exactly. If you stick to your budget of $100, you now buy 10 steaks. So let's look at your haul. In week 1, you got 2 steaks. In week 2, you got 10 steaks. You have 12 steaks total.
Right, 12 steaks in the freezer.
You spent $200 total, meaning $100 each week. So $200 divided by 12 steaks, that is roughly $16.60 per steak. That is your average cost.
Okay, $16.60 per steak. That's a pretty good deal.
But ask yourself, what was the average price at the store?
Well, it was $50 the first week and $10 the second week. So 50 plus 10 is 60, divided by 2 is $30.
Exactly. The average price on the sticker was $30, but because you bought more when it was cheap, your actual personal cost is only $16.60. You beat the average price by almost half.
Whoa, that really puts it in perspective. So the average price on the sticker was $30. But my personal cost was $16.60.
That is the magic of dollar cost averaging. You have essentially created a discount for yourself just by adhering to the math. You end up with more cheap steaks than expensive ones without ever having to predict when the sale would happen.
That's the key, right? Without predicting. Because in the real world, unlike the butcher shop, we don't get a flyer in the mail saying, stock market crash next Tuesday.
No, we don't. The market could crash tomorrow, or it could boom for another 5 years. We have no idea. And this connects to the broader companion strategy Graham discusses in Chapter 4, which we should definitely touch on. Dollar cost averaging works best when paired with Graham's rebalancing rule.
This is the 50-50 split we talked about in a previous lesson. The defensive investor keeps half in stocks, half in bonds.
Right. The defensive investor maintains a portfolio of roughly 50% stocks and 50% bonds. This is Graham's way of controlling overall portfolio risk.
So how do DCA and rebalancing work together? Because they seem like 2 different mechanisms. One is about putting new money in, and the other is about moving existing money around.
They are different mechanisms that achieve the exact same psychological goal. They force you to be a contrarian. Think about the rebalancing mechanism. If stocks rise significantly, let's say a big bull market like we saw in the late 90s or the early 2020s, stocks might become 60% or 70% of your portfolio simply because they grew faster than the bonds.
So I have too much in stocks because they got expensive. I'm overweight in the risky stuff. My portfolio has drifted.
The rule says you must sell stocks to get back down to 50%, so you are forced to sell high. You take that profit and buy bonds. You are trimming the flowers to water the weeds, so to speak.
And if the market crashes?
Stocks fall to 40% or 30% of your portfolio. The rule says you must sell bonds and buy stocks. You are forced to buy low. You are buying the asset that everyone else hates right now.
So both strategies, DCA, and rebalancing are basically robots that force you to buy low and sell high, even when your emotions are screaming at you to do the opposite.
Precisely. It automates buy low, sell high. And this brings us to the psychological benefits, which Graham emphasizes heavily. He calls it the art of doing nothing.
The Art of Doing Nothing. I love that title. It sounds like a Zen book, not a finance book. It sounds peaceful.
It is Zen in a way. Remember the quote from the introduction. The investor's chief problem, and even his worst enemy, is likely to be himself.
We've quoted that in almost every deep dive.
Yeah.
It really is the thesis of the whole book.
It is, and DCA is the weapon against that enemy. It removes timing risk. You see, most investors wake up every morning and unconsciously ask themselves, is today the right day to buy?
Or worse, is today the day the bubble bursts? Should I sell everything? It's that constant low-level anxiety that just eats at you.
That question is incredibly stressful. It induces anxiety, it leads to paralysis. By adopting DCA, you remove the question entirely. You don't worry if today is the right day. Every day is the right day because the system handles the volatility. If the market drops, the system says, great, we get more shares. If the market rises, the system says, great, our account value went up.
You win either way. It really reframes volatility completely. Instead of looking at a red arrow on your phone and feeling sick to your stomach, you look at it and think, oh good, my automatic transfer is going to pick up some bargains on Friday.
It turns you into a partner of Mr. Market rather than his victim. You stop fearing his mood swings and start profiting from them. You start to see volatility as the engine of your wealth, not the destroyer of it.
Let's deepen this with some stories. Section 3 of our outline. We talked about Lucille Tomlinson's study, but I want to go deeper into the narrative proof here, because it's one thing to say it works in theory or it works with stakes, and another to see it survive actual history.
Well, let's look closer at the Tomlinson study from Chapter 5. It's really important to understand the context. This wasn't a simulation on a modern computer. She was looking at real historical periods involving the Dow Jones Industrial Average.
And those periods included some pretty nasty stuff. We aren't just talking about a mild recession.
We are talking about world wars, the Great Depression, the post-war inflation spikes. These were times when it literally felt like the world was ending. Imagine being an investor in 1930. The market has crashed. Unemployment is skyrocketing toward 25%. Banks are failing left and right. The idea of taking $500, which was a lot of money then, and putting it into the stock market felt like setting it on fire.
It would feel insane. Everyone else is selling. Your neighbors are telling you to hoard gold or put cash under the mattress. The newspaper headlines are screaming market collapse every single day.
But the DCA investor buys. And because they bought through the 1930s, when prices were depressed for a decade, not a month, a decade, they accumulated massive positions. They bought share after share after share at rock bottom prices. When the recovery finally came in the 1940s and 50s, those cheap shares exploded in value.
That's the certainty Graham talks about. He says, regardless of what may happen to security prices. That's a very bold claim. He's basically saying the price action doesn't matter to the ultimate success.
As long as the underlying asset doesn't go to zero, which for the entire U.S. economy is a fairly safe bet unless we have a total societal collapse, in which case your portfolio is the absolute least of your worries. Volatility is just an opportunity engine. The only thing that can kill the strategy is the investor stopping.
Let's fast forward a bit. Jason Zweig, who wrote the commentary for the modern edition, brings this into the modern era with the dot-com crash. This is 1999 to 2002. I remember this era. The exuberance was everywhere.
A brutal time. The NASDAQ lost nearly 80% of its value. It was a bloodbath for tech stocks. Companies that had Super Bowl ads one year were bankrupt the next.
So let's tell the story of two investors here. Let's call them Investor A and Investor B to illustrate the divergence in outcomes.
Okay. Investor A is the lump sum investor who tries to time the market. It's 1999, the internet is booming, pets.com is soaring, everyone is getting rich. Investor A gets FOMO, fear of missing out. They take their $100,000 life savings and dump it all into the market right at the peak. They think, this is the new paradigm, stocks only go up.
Ouch. We know exactly how this ends. They bought the hype.
It ends in tears. The market crashes. Their $100,000 becomes $50,000, then $30,000. They are devastated. It took years, in some cases over a decade, for the NASDAQ to get back to those 1999 highs. Investor A is dead money. For 10 years, they lost a decade of compounding. And psychologically, they are probably scarred for life. They might never invest again.
Now let's look at Investor B, the DCA disciple, the boring investor.
Investor B didn't have $100,000, or maybe they did, but they just stuck to the plan. They invested $500 every single month. They started in 1999, right at the peak, same as Investor A.
So their first purchase immediately loses value. They start in the red.
Yes. But then the next month, they buy again. And the market is down 10%. They buy more. Then the market crashes 50%. They buy again.
They're buying all the way down, catching the falling knife, but with safety gloves on.
Exactly. As the market crashes 50%, 60%, 70%, their $500 is buying 2, 3, 4 times as many shares as it did at the start. They are aggressively lowering their average costs. They are accumulating a massive number of units. While investor A is crying about the lost value, investor B is quietly vacuuming up ownership of the American economy.
This is the accumulation phase.
Exactly. And here is the kicker. Because they bought so many shares at the bottom in 2001 and 2002, their break-even point happened much, much faster than investor A. When the market started to recover in 2003, investor B became profitable way before the market reached its old highs.
That is a crucial point that people always miss. You don't need the market to get back to the all-time high to make money. You just need it to bounce off the bottom.
Correct. The crash was actually good for the DCA investor. It allowed them to lower their cost basis significantly. If the market had just gone up in a straight line, they would have made less money because they would have bought fewer shares.
That is the truly counterintuitive part. If you are a net buyer of stocks, if you are saving for retirement and you're in your 30s or 40s, you should actually want the market to crash.
You should want cheap stakes. Graham says this explicitly. Why would you want the price of something you are actively buying to go up? It makes no logical sense.
It's because we look at the account value today and feel rich, instead of looking at the future buying power. We confuse the scoreboard with the gain.
Precisely. We look at the liquidation value, not the accumulation value. Unless you are retiring tomorrow, the liquidation value is totally irrelevant.
We should also mention the NYSE plan. This wasn't just some theoretical idea floated by academics in an ivory tower, right?
No, in the 1950s, the New York Stock Exchange actually promoted a monthly investment plan. You could invest as little as $40 a quarter. It was institutionalized DCA. They recognized that for the small investor, this was the only safe path forward.
It's interesting that the NYSE itself promoted it. They wanted the little guy in the market, but they knew if the little guy tried to trade like a pro, he'd lose his shirt and quit forever.
Exactly. It was a way to make the market safe for the defensive investor. It was a formal recognition that behavior is the primary driver of returns for the average person. It was an acknowledgement that Wall Street is inherently dangerous if you don't have a structured plan.
Which brings us to today. Section 4. Why this matters today in the context of 2026. It is Sunday, February 22, 2026. How does a real person do this now? Because we don't have the monthly investment plan anymore.
We have something infinitely better. We have the 401k, we have auto-invest on robo-advisor apps, we have frictionless, zero-commission trading on our phones.
It's completely frictionless now. You can set it up in 5 minutes while waiting for a coffee.
It is. In fact, most people listening to this might be Graham disciples without even knowing it. If you have a paycheck deduction that goes straight into an S&P 500 fund every 2 weeks, you are practicing Lesson 13.
You are doing the Lucille Tomlinson strategy.
You are. And that automation is a superpower Graham would have absolutely loved. In his day, you had to physically mail a check or call a broker. There was friction. Friction gives you time to think. Friction gives you time to second-guess yourself. Do I really want to mail this check? The news looks really bad today. Now, it happens before the money even hits your checking account.
But despite all that, people still lose money, even with auto-invest. Why? If the system is perfect, where does the human error creep in?
Because they stop. They intervene.
A modern trap.
Think back to the volatility of the early 2020s. The 2020 crash or the 2022 inflation bear market.
Oh, I remember 2022 well. Inflation was high, tech stocks were getting absolutely crushed, interest rates were spiking. It felt like a slow-motion car crash that wouldn't end.
And what happens? The market drops 20%. The news is screaming about a looming recession. The human brain screams, "Stop the bleeding, turn off the auto deposit. I'll just wait until things settle down."
I'll just wait until it looks safe. I've heard that so many times from friends.
That sentence, "I'll wait until it looks safe," is the most expensive sentence in investing history. Because when does it finally look safe?
When prices are back up. When the sky is blue again.
Exactly. When prices are high again. If you turn off DCA during a downturn, you completely destroy the strategy. You miss the cheap stakes. You only bought the expensive ones. Then you turn it back on when the stakes are expensive again. You have successfully bought high and not bought low.
So the strategy requires a very specific mindset. There's a phrase that's become popular in the finance community lately. Just keep buying.
It's the modern equivalent of Graham's philosophy. Look, we are in 2026. We are in an era of AI trading, high-frequency algorithms, and massive global macro volatility. The retail investor cannot compete on speed. You cannot compete on information. You cannot outtrade a supercomputer that analyzes news articles in microseconds.
No chance. You're bringing a knife to a nuclear war.
But the supercomputer has a weakness. It has to answer to quarterly returns for its clients. It has leverage limits. It has risk parameters set by humans who get scared. You, the individual investor, have one massive advantage: time. You can just keep buying. You can be dumb. The dumb strategy of buying every Friday is the only way to survive against the machines because you are playing a completely different game.
It shifts the focus. You stop asking, what is the market doing, and start asking, am I sticking to my schedule?
And that shift brings profound peace of mind.
However, we have to be responsible here. We are teachers, not cheerleaders. Section 5, the limitation. Where does this break? Because Graham was a stickler for details, and he didn't believe in magic bullets.
No, he didn't. And he offers a specific warning in Chapter 5. He cautions against the initiation of a new dollar averaging plan when market levels appear clearly dangerous.
Okay, let's unpack that carefully. A new plan.
He means if you have a massive lump sum, say you just inherited $100,000, and the market is in a historic, obvious bubble, comparable to 1929 or 1999. Graham suggests that blindly starting DCA right at the absolute top might be mathematically suboptimal compared to waiting for a correction.
But wait, he also says predicting the market is impossible. Isn't that a contradiction?
That is the contradiction, and Graham struggles with it too. Graham admits that identifying the peak is nearly impossible in real time. So while he offers the warning, in practice, for the defensive investor, trying to identify the peak usually leads to sitting in cash for years while the market just keeps going up.
So the warning is there, but it's exceptionally hard to act on without becoming a speculator.
Yes. But there is a much more serious limitation we need to discuss. We call it the Japan scenario.
The permanent decline, or the lost decade.
Look at the Japanese asset bubble. The Nikkei index peaked in 1989. It was a massive, unprecedented bubble.
And it didn't get back to that high until, what, 2024? 35 years later.
Right. Now, if you were DCAing into the Nikkei starting in 1989, yes, you lowered your average cost as it fell. But for 20 or 30 years, you were basically underwater. You were pouring money into a hole that wasn't filling up.
So DCA assumes something fundamental about the asset.
It assumes the underlying asset has a long-term upward drift. It assumes the economy will eventually grow. This works for the U.S. economy, or the global economy, generally speaking, because of long-term productivity and population growth.
But it doesn't protect you from a broken economy.
No, and it definitely doesn't protect you from a bad single stock.
This is a crucial distinction. DCA works for indices, broad diversified markets. It does not necessarily work for individual stocks.
Correct. If you DCA'd into Enron, you just lost more money efficiently. If you DCA'd into Lehman Brothers, you went to zero. DCA lowers your cost basis, but if the asset eventually goes to zero, your average cost doesn't matter. You lost everything.
So the lesson is, DCA is a tool for diversified portfolios. Don't use it to double down on a losing speculative bet on one company.
Exactly. Don't throw good money after bad. DCA is for buying the haystack, not the needle.
Okay, that brings us to the big debate. Section 6. DCA versus lump sum. Because every time this topic comes up on finance Twitter or Reddit, there is an absolute dogfight.
It is the eternal debate. The Hatfields and McCoys of personal finance.
The conflict is this. If the market goes up over time, shouldn't I just put all my money in today? Why wait? If I have $10,000 to invest, why drip it in over 10 months? Just die today.
And statistically, the critics are right.
They are.
Yes, Vanguard, Schwab, they've all done the rigorous studies. Lump sum investing beats dollar cost averaging about 66% of the time.
2/3 of the time, lump sum wins. That's a significant majority.
Because markets trend upward, cash sitting on the sidelines waiting to be averaged in is missing out on time in the market. It's called cash drag. If the market goes up 10% while your money is sitting safely in a checking account, you lost that 10% gain.
So why are we spending an hour praising DCA if it loses to lump sum mathematically? Why wouldn't Graham just say, buy it all now?
Because we are not robots. We are emotional humans. This brings us back to the psychological argument. And here, DCA wins flawlessly.
Pushback, using Graham's defensive investor persona. Why does the defensive investor choose the mathematically inferior strategy?
The primary goal of the defensive investor is freedom from bother and avoidance of serious error. Let's play out the scenario. You have $100,000, you listen to the math guys, you lump sum it all today.
I'm all in. I'm maximizing my expected value.
Tomorrow, a geopolitical crisis hits out of nowhere, the market drops 20%. You just lost $20,000 in 24 hours. How do you feel?
I feel sick. I feel like a complete idiot. I want to sell before I lose another $20,000. I am panicking.
And if you sell, you realize the loss. You have made the serious error Graham warns against. You have turned a temporary decline into a permanent, devastating loss.
Okay, now let's do the DCA version.
You have $100,000. You decide to invest $10,000 a month for 10 months. You put in the first $10,000 today. Tomorrow, the market drops 20%.
I lost $2,000 on that first chunk. That stings a bit, but I still have $90,000 in cash sitting safe.
And what are you thinking about next month?
I'm thinking, wait, next month I get to deploy my cash and buy shares at a 20% discount.
Exactly. You feel smart. You feel prudent. You are actively happy about the drop because you have cash ready to deploy. The drop isn't a disaster, it's an opportunity.
So DCA is a regret minimization framework.
Exactly. It is not a profit maximization framework. It is a regret minimization framework. The cost of DCA, the fact that it underperforms lump sum slightly in bull markets, is the insurance premium you gladly pay for peace of mind. It ensures you don't panic sell.
And since panic selling destroys more wealth than anything else in the history of markets, that insurance is worth every single penny.
It is the fee you pay to keep yourself in the game. If you can't stay in the game, the math doesn't matter.
That is such a powerful way to look at it. It's not about optimizing the spreadsheet. It's about optimizing your sleep.
And optimizing your behavior. If you can't stick to the strategy, the best strategy in the world is completely worthless.
All right, let's wrap this up with something very concrete. Section 7, the takeaway. We always want to give the listener something they can do on Monday morning.
The advice here is simple. Automate radical ignorance.
Automate radical ignorance.
I really like that. What does it look like practically?
Step 1, check your investment accounts. Is the transfer completely automatic, or do you have to click a button every month?
A lot of people still manually move money because they like to feel in control. They like to look at the price before they click buy.
If you have to click a button, you are failing. Because one day you won't want to click it, the market will be scary, or you'll want to buy a new TV instead, or you'll just forget. Make it automatic. Remove your decision-making ability entirely.
Step 2.
Step 2 is adopting the just keep buying mindset. Commit fully to the art of doing nothing. When the next crash comes, and it will come, maybe next week, maybe in 5 years, do not log in. Do not check the balance. Let the machine buy the cheap shares for you.
Trust the math. Trust Lucille Tomlinson. Trust that buying cheap steaks is good, even if the butcher shop looks like it's on fire.
That's a very vivid image.
Yeah.
But it really captures the essence of it perfectly.
Graham's genius wasn't just analyzing balance sheets, it was analyzing human nature. He knew we couldn't handle the stress, so he gave us a system to completely bypass our emotions. He gave us a way to be successful without having to be smart.
And sometimes, realizing you don't need to be smart is the smartest thing you can possibly do. That was lesson 13 of 14 on The Intelligent Investor, the definitive book on value investing. Subscribe for the full series. If you haven't seen our debate overview of the whole book, check that out, link in the description. Thanks for being here. See you next time.